Good morning, ladies and gentlemen. Well, this week marks the half year, and it's always useful to review where we were and where we are now and how we got there and what has changed in the meantime. The score this week stayed very high, in the mid-80s. What's happened so far this year? Well, we started with a score of around 85, 89. And we've basically maintained it. Anything in the 80s is quite strong. The trend has been strong, and really the pullbacks have been minimal. There is very little reason to expect a pullback anytime soon with a score as good as it has been. The fact that we closed so weak last week and we closed so strong this week, with the score actually going up last Friday, indicated to me that the odds of some breakdown in equities or risk in general were very, very low, and thus it has proved. I think we are in a continuation pattern. Risk is going to remain strong with occasional pullbacks, but overall I see nothing to change my mind that equities are going to continue to perform for the rest of the year, with minor setbacks of course. But we will have a look at what the yield curve is telling us, and we will have a look at some potential targets for year end. There is no doubt that the first half of the year has been in the sign of steepening for the yield curve. This is where we basically started the year around 70 basis points. We went all the way up to 170, 160 basis points, and we have retraced quite a bit. The best part of the retracement has been since the Fed basically told us that they are looking to taper and then hike at some stage. Whether that happens in 2022 or 2023 is really immaterial. That has crushed inflation fears in the yield curve, and I think it will continue to do so. I think at some stage we will revert back to this kind of range around the 100 basis points. As hikes become more likely sooner rather than later, because the economy does better and better during the reopening, that should be the path of least resistance, one of flattening of the yield curve, which is in general good for equities. We had, while this was going on, we had the underperformance in tech. And while this has been going on, we've had I wouldn't say the resurgence of tech leadership, but I would definitely say that tech has been holding its own, even doing a little bit better on a relative basis. And the yield curve explains it. Since I don't expect the yield curve to steepen materially over the course of the rest of the year, I think growth stocks are going to be, if not leaders, then certainly not laggers, and therefore I would have thought that the Nasdaq will do relatively well. The yield curve did steepen very slightly last week, but that to me is absolutely normal. When you have a move like this, and this is 530s, it got to just that line around midnight on Monday. The retracement back to 124 is absolutely normal to me. Even a slight, sort of further retracement over the next couple of weeks down to 139.7, 140 basis points is really nothing to be afraid of. I think we are now in 139 to 105 basis points trading range for quite a few weeks. And then we will see whether the forces of inflation or deflation will win out. It's still far too early to tell. I think the Fed has definitely got all the tools that it needs to kill inflation. It's just a question of whether they will use them in time. So at some stage the yield curve will flatten further. It's only a question of, do we steepen first? I would have thought that a period of indecision between 139 and 105 is what we're going to get, and that is certainly not something that is going to pressure equities too much. Any retracement in equities is likely to be of a technical nature as opposed to a fundamental macro nature. Fear of inflation is going to be, as I've told you several times, is going to be shown here in this part of the yield curve, which is the 10s, 30s. Where did we start the year in 10s, 30s? We started it right about here at what is this 45 basis points, and we're closing it at 63 basis points. That is almost a 20 basis point steepening, which says that there is some fear of inflation out there. But as long as we keep on holding these levels around 80 basis points, it's not as pronounced as people would make you think. And the fact that we've retraced all the way to 56 basis points and touched it perfectly and then came back tells me that it's still in people's minds, but it's not absolutely at the forefront. We really need to break 80 basis points on a closing basis for people to start being really afraid of inflation. I don't think that's going to happen. I think that we are going to eventually break this 56 area as the Fed comes closer to A, tapering, and B, tightening. To me, the natural path of least resistance will be a flattening of the yield curve in the second half of the year, especially if tightening expectations are brought forward because the economy is stronger than expected. That, to me, is still the more likely path. I'm open to everything and I trade it week to week. But as long as now this yield curve stabilizes, this part of the yield curve stabilizes around 65 basis points and does not go down towards 80 basis points, I still think that it's more likely to flatten than it is to steepen, and that to me will mean that growth stocks are going to be just fine. I finally wanted to show you also 5s, 10s. Okay, 5s, 10s, this is where we started the year, and we are closing the year very much, within a basis point of where we started it. That to me says that now the Fed, the inflation expectations, tightening expectations are moving forward. And the 5-year to me is probably the sector which has the least attraction. It is the one that's going to get hit hardest on any bringing forward of tightening expectations from the Fed. If we have a look at a chart of the 5-year, to me this is a very dangerous formation. I think that at some stage we will test the 116 basis point area. I think the 5-year is the one that has the least to look forward to, while the 10-year is going to remain roughly stable. You can see the differential in what it looks like. If you just rewind this video, you will see how much. In fact, I'll do it for you very quickly. This is 5s. You can see that it's looking to go towards 120. While 10s is going to stay in a range of about 170 to down 139. It's going to meander in this range. And the 30s is the one that's looking actually best. I would have thought that any move towards 225 is going to cap it very nicely. So what does that mean for TLT? It means that we're going to stay in a 137 to 146 range for the foreseeable future. We are basically, if I enlarge this part of TLT, we're basically going to crawl and be supported by this very long-term moving average from 137 up towards 146. This is going to be the trading range for 30s. So really 30s I don't see going much higher than, say, this kind of area, 230. We are going to be basically stuck, which makes sense. What is the yield curve telling you? The yield curve is telling you that there is some inflation expectations. It's telling you that the market believes the Fed can deal with it, and it also believes that the Fed will tighten probably in the early to mid part of 2022, and that the tightening cycle is not going to be that high, that the terminal rate that they expect is not going to be much higher than the 1 to 1.5% area. Much the same can be seen in Europe. This is the bubble, and basically we started the year around 75 basis points. And halfway stage we're here at minus 55, so basically we've lost 20 basis points of negative yield, and we are closing towards the highs. I really at some stage over the next 6 months expect these highs to be broken, especially in the bubble. Inflation expectations either are global or they're nowhere. There is no way that commodity prices are not going to impact inflation in Europe to a degree. It might not be the same degree as in the US, but then you would expect that the yields between US and Europe would diverge. We'll have a look about that. So that was the bubble. This now is the Bund, the 10-year tenure. We started the year here at around 55 basis points, and we are now at minus 15 basis points, so we've lost more in the Bund. But then again, what that is telling us is that basically Europe is a year or two behind, or the market is estimating that Europe is a year or two behind the Fed. The ECB is going to be easier than the Fed, not as hawkish, and it will take longer for them to hike rates. I don't think that that is necessarily right, because I think that either inflation happens everywhere, either the reopening happens everywhere, or it happens nowhere. Will the Fed be ahead of the ECB by a few months? I think so, but I don't think it's going to be years. I think it's going to be months, and therefore I would expect, or at least the market is telling me in this chart, the fact that we started the year here, at 155 basis points differential, and we're closing it at a 167 point differential, that the difference in timing between the ECB and the Fed, the market has taken it mostly back. And I think that we stay in this range, 152 to 174, for a long time. What does that indicate? It indicates that the differential between ECB and the Fed is not going to be that great. And therefore, I would have thought if you're expecting the 30-year and you're expecting the 10-year note to remain roughly stable, the pressure is going to at some stage develop in the bubble sector of the European market. I think, it's too early for the shats, for the 2-year note, but at some stage I expect a real mare to happen in the bubble, and here we are. That's the chart of it. Again, I really do expect these highs to be broken. If we go, if we take this all the way back to maximum we can go, how far do I expect this to go? I expect this to go a long way. I expect certainly at some stage these levels to be tested, which is around minus 32. I'll put a line in here. I certainly think that over the course of the next 6 months, we will get to here in the bubble, because the expectations will be for an acceleration of the hike window or the tightening window in the ECB. What to say about the most frustrating market in the world that I have not said many times? If we look at where we started the year, we basically started it just above 90, and where are we? 91.80. So that is 1.75% in total, which basically is the interest rate differential between the other currencies and the dollar. The dollar yields more, and that's all that can be said. I think the path of least resistance for the dollar at some stage is still down. We still have to price in probably the fact that the US will tighten first, and that is why we are retracing, pricing that in, and once that is fully priced in, I think the only way for the dollar is down. If we have a look at the enlarged daily chart, the levels I think are very clear. On the weekly chart, it's 93.14. On the daily chart, it's 93.63. That is the level of highest risk reward for to buy puts, longer term puts in the dollar. I think we probably get there, and we probably even get to 95.07, which is, as people who've been following me for a long time know, that is my long-term real swing level. Is this going to be some kind of ABC retracement, flat retracement to around 95.07? Very possible, but I think at that level the dollar is so overextended that the odds of it falling are, very, very, very high. Anywhere between 93.63 and 95.07 is a wonderful level to get on board some very long-term dollar puts, and I think that is going to be extremely, extremely profitable. If we translate DXY into Euro USD, you can almost see what they're doing. They're going to get everyone excited on a break of a head and shoulders. Okay, that to me is probably the most likely thing that people will talk about. The market will get down to somewhere around here, just around 114, and then it will reverse and do a leg higher. If we do that, if we look at it at the weekly level, this is the area that it could get to, and that actually would tie in very well with what I've been saying on DXY around that 93.60 to 95 area. So that's 115.34 to 114.35. If we get it down here, I'm going to be so long of calls it's not true, simply because I think once we have priced in the differential between when the Fed hikes and when the ECB hikes, that's all you're going to get. And then as that comes into play, and it will have been priced in, the only way for the dollar to go will be down, and the only way for the euro to go will be up. That analysis for a market which pushes the dollar higher and gets everyone very excited to around 115 Euro USD is actually explains very well what gold is doing. It touched precisely 1764, what we got long, and has been very, very frustrating for the past 5 days. It got into the mid to high 1790s, but it just cannot do any better than that. You know, can it get up to 1810, 1820? Absolutely, but it's just basically opening up these Bollinger Bands, and one day or another is just going to come straight crashing through this 1764 level. And then we're likely to touch 1685. Do I think it goes any lower than that? I think it gets everyone bearish at around 1658. I think it gets everyone bearish at around that level. And then with the dollar, it'll just come straight back. Where did we open the year in gold? We opened it around the 1900 area, and you know, basically we have been on a one-way street, really. We just sort of went down, we went back to the beginning of the year, and we're going back down. I find it very hard to believe that we are going to be much lower than the 1670s in the next few weeks. And I think there, just like the dollar is a good sell when it gets into the 115s, I think it's going to be a great buy to buy gold below the 1700s. It's just going to be a mirror of the dollar, and I've already told you that I think the yield curve is more likely to flatten than not, and that tells me that the pressure on gold isn't going to be that high. Gold is not, I mean, the fact that the inflation expectations are getting less, yes, I mean, it weighs slightly on gold, but the fact that we've already adjusted those expectations, and that is what this move here was, it doesn't mean that it has to go down forever. I think anywhere around the 1650s is going to be a wonderful buy. People are going to be all bearish because we've broken those lows, those previous lows, and then it's going to reverse. That's, I think, the likeliest thing for gold over the next 6 months. I keep on saying, if you want to be long of something in the commodity space, be long of DBC, i.e. more energy components rather than precious metals. This chart puts it very much into context. Where did we start the year? We started the year about here, around 14, and here we are at 19. This area here between 1841 and 1868 now has proven itself. I think any weekly close above 1841 would be very significant, but we're not getting them. I think the path of least resistance remains higher. That would indicate that energy and other commodities will remain relatively strong, and that should keep on putting the pressure on the Fed to act sooner rather than later. And I think that that is right. I think there is no way that the Fed will manage to postpone rate hikes into 2023, because either we have inflation or we don't. There is no way the market just marks time for 1.5 years waiting for the Fed to, say, oh yes, okay, let's go. No, the market will force them to act far sooner than they would want to. And therefore, if DBC remains strong, and all the signs are that there is no rotation out of DBC for the time being, then yes, this is the market to be long of, not gold, not yet. I want to start the equities analysis with Nikkei, because I think Nikkei and EM show you exactly what is going on in the equity world. Where did we start 2021? We started it, basically, you can see the open was 26,600. Okay, so this is where we started the year, and in a month or two we went to the highs, and then since then we've been doing absolutely nothing. You can see how on the weeklies the Bollinger Bands are restricting, have restricted. We are very, very close to a big move. Very close. Matter of month or two, and we will break either 30,205 on the upside, and then we will probably get a close to 10,000 points in the Nikkei, or we will break the 26,940 level on a weekly basis, and then we probably come all the way down to 24,200 to 23,000. My favorite is a bust to the upside. If we have a look at EM, you can see that basically we have done much the same. We opened the year at 50, just over 50. We went very quickly within a month or so up to the high of 58 and odd, and then we retraced back to the beginning of the year. We've been bouncing off the beginning of the year, and we're closing up about 10%. So basically we are, what are we doing? We are holding our own in EM against SPX. Is this more likely to bust up than down? Yes, I think it is. I think the continuation pattern here in EM is the more likely. I just cannot get bearish of EM until we close below 52.08. Anytime that we are still doing this and the spread between Nikkei and EM is absolutely flat, I can even show you that. This is Nikkei to the EW, sorry, EM to EWJ. You can see that basically since the beginning of the year we've done nothing. You know, EM is slightly better than Nikkei, but the relationship is very close. You can see that we are basically just going sideways. Now, is there a possibility that EM breaks up towards these levels against EWJ? Yes, there is, but I think it's more likely that the tight correlation between EWJ and EM, i.e. Nikkei and EM, remains pretty constant for a while, and that is why I think the risk reward is going to be playing a breakout in the Nikkei when it happens. Right, well, back to the bread and butter of the SPX. As I told you last week, 4180 was going to be key. As soon as it broke 4180, it was pretty obvious to me that, you know, not a lot of downside is coming here. 4232, 4233 is absolutely key, and as soon as we broke above it, let's enlarge this area so you can see, as soon as it broke above it, and there's absolutely zero retracement, zero pressure. It just kept on going. That was the risk reward point, 42.32. As soon as that didn't hold, hello, it's gone. What does that show you? That shows you that the actual pressure on equities is temporary and it's very weak. To me, you know, every time buying call spreads, every time it gets to a very important level is the thing to do, or buying outrights and selling calls, or any strategy which limits your down, you know, limits the potential downside. The only hedges worth having are the ones which are free. Anything that you pay out for, you will lose the premium. It's quite obvious. There's, you know, now you have every single, the only things worth playing are breaks of 42.32, in which case it goes down to 41.80. That is the only area worth hedging. Everything else you just let run. If we take that to a daily basis, you can see how all these moving averages are coming out. Yes, we do have the this amazing the Bollinger Bands. Oh, sorry about that. Let's see what we can do. We can go backwards. You know, the Bollinger Bands are right here, and they do catch the market very nicely, which basically means Monday, Tuesday, we can go sideways and then break up. But I think the likelihood of pressure coming in on the SPX over the next few days ahead of the markup of Q2 end is going to be almost zero. If we have a look at the weeklies, here we are, we can see how important 42.32 is now on the weekly closes. And below that, we know where we are. 41.28 to 41.14 will remain key. No way do I see any of that tested. It's more likely to go above into the 4300s, 43.30, something like that by the end of the week. The market doesn't want to go down. You know, this kind of pattern tells you everything there is to know. Faint down, straight back up. Next week, no doubt, we will hold 42.32 and then we go up. I really see not a lot of pressure here. Where did we start the year? We started the year at 37.11 and we are well over 10% higher. So it's likely to be a continuation pattern for the next 6 months. It's going to go from level to level. This kind of pattern says continuation. Just as the levels are very clear in SPX, they're just as clear in NQ or the QQQs. 14,044, 13,717. While the market is above 13,717, there is nothing to see here on the downside. It really is as simple as that. The fact that I expect the yield curves to remain static to slightly flatten, indicating less inflation, to me that shows you that NQ, if not being a leader, it's certainly not going to be much of a laggard anymore. I just can't see that being a very big preoccupation for the market. The fact that we've closed so clearly above the previous high of QQQ indicates to me that all the pressure is going to be to 350 and above over the next few weeks. Can there be retracements down for 14,044? Absolutely, but I think that will all get bought. And, you know, by the end of next week, I'll be surprised if we haven't got to quite close to 15,000 on the last final spurt to close the Q2 at the best possible kind of valuation. I wanted to show you the relative performance of the sectors against tech during the course of 2021 and show you basically how the yield curve has influenced them all. Where did we start in XLF against XLK? We started the year here and this is where we are. The yield curve steepened. This favored XLF over XLK, and this is where we are. Do I expect this to do much better than 27? No, I think it's going to now remain in a range with 27 as the highest level. But this is the interesting one, which is basically QQQ against SPY. We started here, and this is where we are. Very slight outperformance by SPY against QQQ. Again, yield curve steepened, and this is what happened. I don't see this being I don't see in the next few weeks that this is going to be very different from the level that we are on at the moment. And that's why I'm saying that I don't think that that the Qs are going to suffer very much. If I think the risk reward is when they fall down to the support levels, it's to start looking for outperformance from the growth sector, because I do feel that at some stage the hikes are brought forward and the yield curve flattens. That will be a tail wind for QQQ relative to SPY, and I will be looking to buy QQQs for an outperformance now every time it falls down to this kind of level, this 79, 72. To me, this is now going to be a much better buy for Qs for the second half of the year. I also wanted to show you charts of the stocks and the DAX. They moved very, very well in the first part of the year, but it's quite clear to me that they are beginning to lose ground, or rather leadership. I haven't quite made up my mind why that is happening. I just, it's obvious that it is happening, so there's no point in ignoring it. I've got here some very important levels in the stocks and the DAX. Below there, it starts getting a bit problematic. I don't think it's going to happen. I think that the relationship, basically what I think is happening is that people are now rotating. It makes quite a lot of sense to me that they should rotate. The Nikkei has been underperforming for such a long time, and EM as well, and Europe has been outperforming, that a little bit of rotation into Nikkei out of Europe makes sense. And this to me is probably going to be the most interesting development in Q2, the underperformance of Europe relative to the Nikkei and the EM. I think that basically people have squeezed out of Europe everything that they can in the short term, and it's time to start looking at Nikkei. It really is. The trend in volatility has also been quite clear. Where did we start 2021? We started around the 22, 23 area, and here we are at 15. We are very much in a different range than we were for the whole of the second half of 2020. We are now in a 2005 to 1558 range. Is there a danger that we fall lower? Yes, but not in the next few weeks, I don't think. You can see how definitely the spikes, every spike is less than the previous one, simply because, as you saw in the SPX, the moves down are very controlled, and they go to levels which are very important and easily identifiable by the market. So I don't expect, what do I expect for the second half? I expect a low of we are not very far away from it in terms of volatility, but I certainly expect anything over 2250 to be sold very rapidly, just like it did here and here and here. I think that the 22 area is going to be very difficult to stay above. Are we going to have, sort of 1-2 day moves above it? Absolutely, but I think it's going to be just like here. You can see a whole period where we just could not break 2250. I think it's more likely than not that we're entering that kind of volatility prism, that we stay between the 15s and the 22s for a very long time. Finally, on to the levels and the biases. As I've told you, these are all the very important levels in the yield curve and in outrights. I don't think we will see many of them next week. I think the market is going to be remarkably quiet. I think it's in everyone's interest to mark things as high as possible, and therefore I expect bonds to be quiet and all the action to be in the equities. I don't think the Nikkei is going to happen next week, but I think on all these dips we really should concentrate on buying call spreads over the course of the next 6 months. I really wouldn't be surprised to see a real burst of activity once we close above the 30,205 area, and a very quick 5-6% move in there. All the other levels are marked. I think that gold, I will, you know what my position is. You know that I've been taking some profit in the 1790s simply because it's just not going up. You can see the resistance is just not being challenged at all, or it's being challenged very briefly. That to me says that DXY is still in a path, corrective path higher, and that gold at some stage is going to burst the 1765-64 area and activate all the stops. I think when we see 1675 to 1658, that will mark the bottom for the year and a move back up towards the 1900 area. But all the levels are here for you, and I will naturally tweet to you any developments on Monday. Thank you very much indeed. Have a wonderful weekend.